Okay, we've done exercise 1 here for chapter 2. We're going to go on to exercise 2. And in this one, basically, we're just making an income statement. We see the company had $720,000 in service revenue. So we're going to put that here for revenue. Their total cost, fixed and variable per client. So the total cost per client, in this case, it's not per unit, but per client, was $2,500. And they served 115 clients during the year. So how do we get the total cost of their services for the year? Okay. $2,500 cost per client times the 115 clients. So that gives us a total cost of $287,500. How do we get gross profit?
Cost of services, revenue.
Yes. So 432,500. All right, then they tell us the operating expenses are 302,000, so we'll put that right there. And then we just subtract gross profit minus operating expenses gives us operating income. God bless you.
Thank you.
$130,500. Okay, questions? Right, well, that wasn't too bad, right? Look at number 3. So let's see, this dog boutique sells clothing and accessories for dogs, gross revenue of $86,500. Where do we put that? Sales, okay. Sometimes it'll say sales revenue. Sometimes it'll say service revenue, fee revenue, but we know all of that is just some type of revenue, right? Okay, and let's see, it says their operating expenses were $27,500. That goes under operating expenses. It says that their cost of goods sold was 24% of their gross revenue. Okay, so how do we calculate that?
Take the 24. Take the sales, subtract the operating expenses.
That would be net, but it's just the gross revenue. So the gross revenue is just the sales, and then I heard over here something.
Yeah. Times by 0.24.
Exactly. Thank you, Daniel. So times the 0.24, right? 24%. So the cost of goods sold was $20,760. Right? It was the revenue times 24% because that's what they gave us. They said that the cost was 24% of the revenue. And again, we will subtract sales minus cost of goods sold gives us gross profit. Subtract operating expenses, get operating income, and then Trav checks to make sure he got it right. Yep, 38,240. Okay, questions on this income statement? All right then, moving on to number 4. This company, it doesn't really matter what they do, except they do construction jobs. So that's their main business, construction. We have to classify their costs as fixed or variable and as product or period. Okay. Now, fixed versus variable, I'll give you a little tip here. If it says per square foot, that's variable, right? Because the more square feet, the more the total cost is going to be. So we know that that's variable. If it says per year, we know that's fixed. because it's the same regardless of production. And then we'll just have to look at what it is they're doing. If they're doing construction, then that's going to be a product related cost because that is their product. They do construction. I guess you could say it's actually a service, but they're building a building, right? The building would be the product. And if it's not related to construction, then it's going to be a period cost. So starting with A, lumber used to construct decks. Is that fixed or variable? Variable. And is it product or period? Product. So I'm just going to abbreviate that, V for variable, PR for product. How about carpenter labor used to construct decks? Variable. And that's a product cost as well, right? Because the carpenter's making the deck. Then we've got C, construction supervisor salary. Is that fixed or variable? Fixed. All right, and is it product or period? Well, if it were a supervisor in human resources, it would be a period cost. Or if it were a supervisor in the legal department or the marketing department, then it would be a period cost. Because it's a construction supervisor, that's part of the cost of production. Even though it's not direct labor, it's not going directly into the product because they're just supervising, right? But it's still considered a production cost because they're supervising production. So this is fixed and production. Okay, next one, depreciation. You remember depreciation, right? From financial accounting. Depreciation on tools and equipment. Is that fixed or variable? It is fixed. And is it product or period? Well, they didn't really tell us what kind of tools and equipment, but I think we can assume it's construction tools and equipment, so it would be product related. If it were copy equipment, like a copy machine, if it were a microwave for the break room, then yeah, okay, that would be a period cost. But if it's related to construction, it's going to be a product cost. Zach?
So if you were to use like the unit method for your depreciation rather than like the linear per year
Okay.
or double linear, would that still be fixed? Because you're accounting for how many units you use it for.
Or depreciation?
Yeah, for depreciation, when you say this is the amount of useful units it can do throughout its lifetime, and then you track how many units you use.
Oh, I see. Like if you were doing the units of production method of
Yeah, that's what I
depreciation,
meant. I forget the name.
then it would be variable. That's a good point. That's a good point. That there is, if you remember the different ways to do depreciation, you can base it on how much you produce. And if you did it that way, then yeah, I guess that would be a variable cost. But generally, we either do straight line, which is fixed, double declining. I think you would call that fixed as well, because even though it changes, it's not changing based on production. But with units of production, you bring up a great point. Okay, E, selling and administrative expenses, fixed or variable? Yeah, it's kind of vague, isn't it? They didn't really tell us what kind of selling and administrative expenses. Oh, but it does say 35,000 per year. So we know it's fixed. And then product or period? That would be period. F, rent on corporate office space. Fixed. Product or period? That would be period, right? Because it's not specifically for production, right? It's not a factory, it's not a warehouse, it's not anything related to building stuff, it's corporate office space. And the last one, nails, glue, and other materials required to construct deck. Okay, variable product. Okay. All right, I think that all looks good. Let's double check. So we said variable product for A and B, fixed product for C and D, and fixed period for E and F, and variable product for G. Okay. We got it all right. Good job, everybody. Any questions on number 4? Okay, we did number 5 already. I'm just going to scroll through it for the benefit of anybody watching this video in the future, so they can pause the video and try to figure out what's going on here. But we're not going to go through it again. I wouldn't do that to you. Okay, let's go ahead and go to exercise 6. So this company is a service company, and last year they provided services to 700 clients. The total fixed costs were this amount, $159,000. I'm going to go ahead and put that here under total fixed costs, because we know that does not change based on production, right? So if those are your fixed costs, doesn't matter how many clients you have, they stay the same. And we see total variable costs were this amount. However, that's based on 700 clients. We're going to have to adjust that for different levels of clients. All right, so we're going to have to figure out a number of things here. We're going to have to figure out total variable costs at each level of production. And we're going to have to figure out the cost per client, both fixed and variable. And then the total cost per client. Okay. So how do we get our variable cost per client?
The 87 minus the 700.
Yep. So we'll take this total variable costs and divide it by the number of clients that were associated with that total variable costs, right? And we see that comes out to $125. So our variable cost per client is $125. We can put that here. And remember, the variable cost per unit or per client stays the same. Right? Total fixed costs stays the same. Variable cost per unit or client stays the same. Okay, well, now we can figure out our total variable costs for each level of clients. How would we get our total variable costs with 500 clients? You know, it's $125 per client, right? So multiply by 500 clients, 62,500. And we'll do the same thing here. 125 times 800 clients is exactly 100,000. And 125 times 900, 112,500. Okay. So now we know our total fixed costs at each level of production and our total variable costs. And we can add those up and get our total costs, right? It's kind of like solving a puzzle, right? Figure out one part, that helps you figure out another part. So here we just add fixed plus variable. Total costs are 221,500. I don't know what's up with the alignment here. This one's pretty easy, 259,000. And the last one, 271,500. All right. Next, we can figure out our fixed cost per client. How can we do that?
We divide the total fixed cost by the amount of clients.
Yep. We'll take our total fixed costs, divide by 500 clients. That's $318 per client. And we do total fixed cost divided by 800 clients. We're going to round this off. Usually the instructions tell you if you're supposed to round it off. I just happen to know in this case that's what they want us to do. So we're going to call that $199. Sorry, I don't know what's up with the spacing here. You know what? I'll take the dollar signs out. Maybe that'll fix it. Weird. Okay. And, and then 159,000 divided by 900 clients. We'll call that $177. Okay. Then we can just add our fixed cost per client to our variable cost per client. And we know our total cost per client at each level of production. So this is 443. $324. And 302. Weird. I don't know why it does that. Okay. Little tedious, but we got it done. Let's double check these numbers. If we just check the total rows, then we'll know that we did everything else right. So let's see how that works. We got 6. Okay, 221,500, 259, and 271.5. So that's right. 443, 324, and 302. And that's right also. Any questions on how we solved that exercise? Okay. All right, let's move on then. Number 7. So here we have a trucking company and fixed expenses are $79,000 in March. We'll go ahead and put that here under fixed cost. And $93,120 in April. So how is that a fixed cost if it changed from one month to the next? We know a fixed cost does not change based on production, right? The total fixed cost stays the same regardless of production, but maybe something else influenced it. Maybe our supplier raised prices, right? So your fixed costs can change. They just don't change based on how much you produced. All right, so these are the fixed costs for these 2 months. Their variable cost, in this case, is per mile. So per mile that they drive their trucks, they have a 15-cent variable cost. Okay, we're going to need to know that. In March, they drove 85,000 miles. That can go down here under miles. In April, they drove 96,000. That can go right here under April. Oh, it can also go up here under March and April up top. It's also miles. So let's finish A and figure out the total costs. We know the fixed portion, we need to figure out variable, right? So how do we figure out the total variable cost for March?
$0.15 a mile.
Yes, exactly right. So we take 85,000 miles times 15 cents per mile, and that gives us the total variable cost for that month. Job, Ivan. So that's 12,750 in variable costs. We can then add that to our fixed costs. And we get our total costs. We can do the same thing in April. Take the miles times 15 cents per mile, 14,400. That's our total variable cost. Add that to the fixed, 107,520. So we know our total cost in March and total cost in April. We actually need that information for part B. So I'm going to copy that and bring it down here. So under part B, we know the number of miles driven each month. We know the total costs. How do we get the cost per mile?
Divide your total miles and the total cost.
Yep, we'll take the total cost divided by the miles, and that'll give us cost per mile. I'll start with April. We get $1.12. In March, we get $1.09. So we can see our total costs went up a little bit, right, from March to April, our total costs per mile. We wouldn't have known that just looking at the raw data. So that's why managerial accountants are needed to help process, develop reports like this so that managers can say, oh, our costs per mile are going up. What's going on? Then they know that there's an issue. All right, ready for number 8? Okay. Oh, that's a short one. Suppose that a company has fixed costs of $18 per unit, variable costs of $9 per unit, based on 15,000 units that they produced. What are the fixed costs per unit if they produce 12,000 units? Okay, well, to solve this, we don't need to know about the variable costs, right? They're asking us about the fixed cost per unit. So we don't really need this information here. We know that if they produce 15,000 units, fixed costs are $18 per unit. Well, what would be the fixed cost per unit if there were 12,000? This is kind of like exercise number 5, I think it was, we did, remember? So how did we figure that out?
Cost per unit that we know is produced.
Mhm. Well, okay, you're almost there. So yeah, the first part is correct. We know that this $18 per unit was based on 15,000 units, right? So if we multiply that, we know then what the total fixed costs are. 270,000. And then we divide by, do you know what we divide by, Joseph? Yes, by the 12,000 units. And we get 2250. So would you like me to write that out as a formula? Would that be helpful? Okay. So what we did is we took our fixed cost per unit of $18 and we multiplied that by 15,000 units to get our total fixed costs of What was it? $270,000, right? Then we divided that, took that $270,000, divided that by 12,000 units to get our 2250 fixed cost per unit. Okay, so 2250 is our answer. And we can confirm that here. 2250. All right, I think we have time for, this is the high-low method. We might not get through this whole exercise, but let's go ahead and get a start on it. This is that magical formula I was telling you about. It's pretty cool. Okay. So here we have, oh, was there any question on that last one? Just to make sure. Okay. So here we have maintenance costs for a company for every month over the past year, right? We see their production in gallons of paint, and we see the total cost. But these are mixed costs, so they include a fixed component and a variable component. And we don't know how much of this is fixed and how much is variable. Our mission is, based on this information, we need to be able to estimate at different levels of production what the cost would be. How would you do that? Well, this is where the neat formula comes in. I'm going to go ahead and make some room here to show it to you. So the formula itself is Y stands for total costs, equals A is fixed costs, plus B is variable cost per unit, times the number of units. Okay. So the short way to write it is this Y equals A plus BX. But if it's easier, total cost equals fixed costs plus variable costs. And variable costs can be broken down to your variable cost per unit times the number of units. So that is our basic formula that we need in order to figure this out. And here's where the high-low part comes in. To make this work, we look at this list. We need to figure out what was the highest month of production and what was the lowest month of production. So let's start there. What do you think? What looks like the highest month? November. How about the lowest month? February?
February.
Okay. So what we do is we're going to use the data only from those 2 months. And we need a different formula. This formula goes cost, the difference in cost divided by the difference in production equals our variable cost per unit. So I'll write it out this way. Difference in costs divided by difference in production equals variable cost per unit. So let's see what that looks like. The cost in November was 72,800, right? And the cost in February was 66,800. So the difference is $6,000. Agreed?
A bit more.
Oh, yeah. Okay. So the total cost in the highest month minus the total cost in the lowest month, in this case equals 6,000. Then if we look at the production, we had 128,000 gallons in November minus 68,000 gallons in February. So the difference in production, sorry, was 60,000 gallons, right? That was the difference between the highest month and the lowest month. So when you do this, when you take the difference in cost between the highest and lowest month, divide it by the difference in units that were produced between the highest and the lowest month, what you get is your variable cost per unit. So 6,000 divided by 60,000, 0.1. So 0.10 cents is, or 10 cents is our variable cost per unit. That's the first part of this process. But we're not done. Any questions so far? Okay. The next step, now that we know the variable cost per unit, we can figure out our fixed costs. Let's go with November's data. We could use we could use the high month or the low month and we'll get the same answer. So we'll do both months, but let's start with November. And so if we know that it's 10 cents of variable cost per unit, and we produced 128,000 gallons, we just multiply number of units times the variable cost. And so we had $12,800 of variable costs in November. We know this is our total costs. So if we subtract the variable costs from the total costs, we get our fixed costs. That's going to look like this. This was the total cost for November. This was the variable cost for November. Right, and the way we figured that out was we took the variable cost per unit times the number of units for November to get that variable cost. And that tells us now our fixed costs. So we've already figured out our variable cost per unit and our fixed costs. Now we can put that into our formula and use it to predict our costs at every level of production. Before we do that though, let's just try this out. Like I said, we use the November data, but let's do the same thing with February. We take 10 cents of variable cost per unit times the 68,000 gallons. That's $6,800 of variable costs in February, right? So we could take February's total costs, which were right here, minus the variable costs for February of 6,800. And guess what? We also get 60,000. So whether we use that high month or the low month, we get the same fixed costs. Zach.
So that only works if fixed costs between the months have stayed the same.
Oh, okay. Yeah, that's true. Because we did see could be a case where your fixed costs change for some reason, but this is assuming your fixed costs are stable. Yeah, okay. So, like I said, the last step now, we can go back to this formula up here. Either this one, or let's just go ahead and use this one. So if we want to figure out total cost at any level of production, it's going to be fixed costs, which we figured out in this case was $60,000, plus variable cost per unit, which we figured out was 10 cents, times the number of units. So if the CEO came and said, what would the total cost be if we had 200,000 units, 200,000 gallons? Well, we know it's going to be 60,000 plus 10 cents times 200,000. So it's a lot of steps to get there, but it's a pretty cool little formula. And we'll go through it more on Thursday, but you'll see it can be fairly accurate for predicting mixed costs as long as your data are fairly stable. All right, questions or comments? All right, we made good progress today. See you all on Thursday.